Hello and welcome to Financial Statement Analysis Lecture 7. Today's topic is on forecasting and it's part 2 to continue on with our discussion of forecasting from last week. As we take a look at our business analysis framework, we're still over in step 3, the prospective analysis or forecasting. Last week we learned how to forecast. We learned the technical side of the forecasting template that we present to you in this subject. In today's lecture, we're going to be looking at some of the nuances and other theoretical issues we can discuss around forecasting. So to start with revision, last week we learned about a forecasting template. We have provided you with a way that you can do comprehensive forecasting of your balance sheet, income statement, and free cash flows for a firm by forecasting 6 items. The 6 items we said we need to forecast are the firm's sales revenue, or their sales growth rate, their asset turnover, their profit margin, if there's any other comprehensive income or other income the firm's likely to earn, their dividend payout rate, and their net borrowing cost or the interest rate on their debt. By forecasting these 6 items and doing some calculations by following this forecasting template, we are ending up with a comprehensive forecast, which gives us comprehensive income, so the bottom line of our profit and loss statement, and our equity, the bottom line of our balance sheet. The items in red, sales, ATO, profit margin, other income, net dividend payout ratio, and net after-tax cost of debt, or the NBC, the items in red are what you have to forecast. You have to estimate or guess these numbers moving forward for your firm. Once you've done these estimations, you can then calculate everything in blue, and you'll end up with your comprehensive forecast. We had a spreadsheet like this from last week for Anna's company. All the numbers in red were our forecast estimations, and then all the other numbers we had to calculate based on those things. So the forecasting template is an easy way to do comprehensive income statement and balance sheet forecasting. It's not the only way that people do forecasting for firms' performance, but it's something we present to you as an easily achievable, comprehensive and consistent way of forecasting a firm's performance. There are many other ways of doing forecasting, but we present this one as something that you can get your head around pretty quickly, and it allows for consistent forecasting based on the fewest number of inputs you can think about for your firm. This week we move on from the forecasting template and we discuss some of the theoretical issues around forecasting and have a more general discussion about forecasting issues. So the learning objectives, we want to understand sensitivity analysis and why that's important. Some other ways of forecasting information using some quantitative methods, so time series modeling. We're going to talk also about financial analysts and their forecast, as well as the forecasts that management of the actual firm you're looking at will often make as well. I wanted to start this week's topic on forecasting by mentioning that forecasting is very difficult. It's hard to create accurate forecasts of the future. You're always going to make mistakes with your forecasting. If I was the best forecaster in the world, I wouldn't be teaching this subject. I would be a multi-billionaire. If you're good at forecasting, your valuations are going to be incredibly accurate and you'll be very successful in what you do. However, forecasting isn't that easy. We're always going to make mistakes when we're trying to predict the future because there's so many unknowns that we just can't comprehend when we're doing our forecasts. What we can teach you in this subject is we can provide you some tips on how you can try and improve the accuracy of your forecasts so they're not completely off and you've got some sort of framework on how to deal with these forecasting issues. The first tip here is to use comprehensive forecasts. The forecasting template we've provided you with does provide comprehensive forecasts of the firm's performance. It allows you to calculate the bottom line of the profit and loss statement and the bottom line of the balance sheet, as well as calculating the free cash flow. Any changes you make to your forecast assumptions affect all the financial statements, which is what we mean by We want to utilize research in making our forecast assumptions. We want to be skeptical of things that the management say. We want to be skeptical of what the analysts forecast. And we want to try and have an open mind with our forecasting and think about things from different perspectives. So let's go through these dot points and give some examples of how we can implement these. A really common mistake people make when they're forecasting business performance is they don't do comprehensive forecasting. They may be doing something like a dividend discount model and they choose to only forecast the dividends into the future. Or they might be valuing the company using a discounted cash flow model and they only choose to forecast the free cash flows into the future. But as we know, all the different things in the business, they all interact with the financial statements in different ways. So if we were to, for example, just do a forecast of dividends in the future, so we could value a company using the dividend discount model, If we're only forecasting dividends, we're not then getting an understanding of how the change in dividend payout ratio could influence things like the growth of the firm, the leverage of the firm, or the actual firm's overall performance. So I'm going to go to a spreadsheet, our Gale Pacific spreadsheet, and talk about this issue with some numbers. So this is going to be just a very simple demonstration that if I was going to value a company using the dividend discount model, these are the dividends that Gale Pacific have paid out from 2016 to 2019. When we prepared our comprehensive forecast using the forecast template, I've calculated the dividends that I expect or forecast into the future using this dividend payout ratio. Imagine I wasn't going to use this forecast template and I wasn't preparing comprehensive forecasts. What an analyst might do, and this is something that people will do, say, okay, last year the dividend was 8,262. I think this company is going to pay a dividend that grows by 2% each year. Okay, so I'm taking last year's dividend and I'm multiplying it by 1.02 to build in a 2% growth rate on the dividend. So then I drag that forward to my future years, and I've now created a dividend forecast without taking into account any of the other things that are impacting the business here. So what did that do to my comprehensive income and my equity outcomes? So I'm just going to flick back to using the comprehensive forecast that we already had. I end up with comprehensive income around 6,000 each year based on these current assumptions. If I change my forecasting approach to just forecasting the dividends with this 2% growth rate, immediately we see a big change in calculate net payments to debt holders. Now, if we weren't doing comprehensive forecasting and we just forecast this number, yeah, those dividends look fine. It's growing at 2%. That's a reasonable sort of assumption to make. Let's plug them into our dividend discount model and come up with a valuation. What that doesn't tell us about the business is for the business to be able to make these kind of dividend payments each year, it looks like they're going to have to borrow a lot of money. We've got negative net payments to debt holders, and that means overall their leverage is increasing. And if we go down here as well, it means that their comprehensive income will be less because they're paying out more money to the shareholders and have less funds available to actually grow the business. And then if we have a look at their return on equity calculations down here based on the forecast, it would also, the return on equity would be similar, but on a smaller equity base with a smaller profit. So if an analyst just wanted to forecast dividends and they said, okay, the dividends are going to grow by 2% each year, that seems reasonable. In that assumption, they're not realizing that for this to actually work out, the company would have to keep increasing their debt every year, which will keep increasing their leverage, which will increase the risk of the business as well. So we're not getting a full understanding if we just do that. So if we flick back to our prior assumption, with these kind of comprehensive forecasts, yes, I've forecast the dividends are going to be going down a lot based on these conservative estimates I've put in here, but we can see how it affects overall the business, and we've got a reasonably steady leverage ratio, and it allows us to make sure our assumptions are consistent and they make sense across the whole business, not just on a single line item. A similar case would be if we were going to use the free cash flows to value the business using a discounted cash flow model. Our free cash flows here are calculated based on all these other operating assumptions. If we're an analyst and we just wanted to say, okay, I think my free cash flows are going to grow from this number a couple of percent each year, it doesn't take into account what is required for the business to generate that free cash flow. What sort of investment in their assets do they need? What profit margins and turnovers do they require to actually generate those free cash flows? And is it consistent with the current competitive nature in the industry? So comprehensive forecasts help us make sure our assumptions are consistent throughout the whole business, and it prevents us making these single line forecasts which may not make sense in context of the whole business. The second thing we want to do when we're forecasting is we want to utilize research that can help us with our forecasting accuracy. So last week, as we went through the forecasting template, for some of the key items such as sales growth, I presented some of these charts which are based on research into US firms. And it broke up sales growth into 5 different groups. Firms that had really high growth, up to 70% on average, the top 20% of firms average 70% sales growth each year. We could see that that's not sustainable for long. Within a few years, they've pulled back to a kind of average level of growth. You can't grow your business at 70% every year for many years before you become so huge you take over the market. So this research illustrates that sales growth rates revert back to the mean. So if you're valuing a really successful company and they're growing really rapidly, keep in the back of your mind that research shows really successful companies, they might still keep growing, but they're probably going to pull back towards the mean average growth rate for the whole economy. Okay, they can't keep outgrowing the economy forever. We also discussed these kind of trends for asset turnovers, profit margins, financial leverage. So use that kind of research and use your knowledge of industry trends to then be able to make sensible forecasting decisions. My next point is that we shouldn't always believe everything that managers, and we shouldn't believe everything that analysts tell us about the future of the company. So we need to be a little bit cynical. We need to apply some critical thinking to the forecasts that managers and analysts also provide us. They can be really useful sources of information, but we shouldn't just take what they say as gospel and believe it straight away, because they often make mistakes. So this podcast here, Masters in Business, is an excellent podcast. I'd recommend all of you to listen to some of the episodes. The host runs his own financial firm. He interviews Nobel Prize winners in finance and economics and hedge fund managers, investors, management consultants, CEOs, a wide range of guests. This guest, Philip Tetlock, he's an expert in forecasting. He's a psychologist at a US university, and his research is all about how can we improve our forecasting. And if you have a listen to this podcast with the link available here, you'll hear some really interesting things, such as when he has researched expert predictions, such as when you watch TV and you see an expert talk about politics and who's going to win the election or what's going to happen in this country's economy, most of the time on average, they're not any more accurate than just the run-of-the-mill casual person who's going to have an opinion. Experts still struggle with forecasting because they're just putting their opinions forward. They're not backing it up with solid empirical evidence or research. And when you watch TV and see these experts make predictions, you'll start to realize there's no one actually keeping track if this is right or wrong. So they don't actually build up a reputation based on if they're right or wrong. They build up a reputation based on can they get themselves on TV or on the radio. So they have incentives to say ridiculous things just so they get some TV time or radio time. No one's going back and checking and going, oh, this guy's been wrong for 70% of his guesses. Why do we bother doing that? So Philip Tetlock's research is really good. He provides us with lots of information about how to improve our forecasting. But one of the key takeaways is don't believe the experts every time they say something, because their incentives to be accurate may not be there. So don't always believe managers and analysts' forecasts because they often make mistakes. A little bit of a discussion about the podcast with Philip Tetlock that I've just recommended. He says, we discuss the people who make predictions in their business, experts on TV like I just discussed, and they're not really better than the general public at making these predictions. Then they discuss, based on his research, how you can actually improve your own forecasting. First, he says, teams of ordinary forecasters beat the wisdom of the crowd by about 10%. Prediction markets beat ordinary teams by 20%. And super teams beat predictions by 15 to 30%. And in his book, he discusses how you can actually create super teams and become expert forecasters yourself by avoiding some of the common mistakes. You don't need to do that for your assignment in FSA, but if you are planning on going into a career where forecasting is important, economics, finance, accounting, marketing, they all require good forecasting skills. This would be an excellent book to read and think about some of the tips, or just listen to the podcast and hear some of the things he has to say. Continuing on with the theme of we shouldn't believe everything we hear, I've got a link to a YouTube video here by Nucleus Investment. They're a managed fund based in Australia, and I really like the research they put out, and I think you should have a watch of this YouTube video and read some of the other articles they write. One of the things that they did fantastically well, in January, they started writing about coronavirus and COVID. And this managed fund actually pulled all their money out of the stock market really early on, in about January or early February, because they were only analyzing the numbers of coronavirus. They were ignoring all the other hysteria and commentary. They were just looking at the numbers and seeing the trends. They noticed a few things, such as the number of cases doubled every 4 days. So they understand exponential growth because they understand finance and compounding. They extrapolated the data out into a sort of global situation and realized, hey, this is going to be really bad. The media commentators who are saying it's not that bad, the World Health Organization who are saying it's not that bad and we shouldn't close borders. If we look at the data and how quickly this virus grows, plus its growth rate, this is going to have huge ramifications for the world economy. They pulled out of the stock market really early on compared to any other investors. And they were completely accurate in what they did. Their forecasts were all based on data and understanding the information and predicting the trends based on that. They removed all the other noise of the commentary about whether it's bad or not, and if we should trust the World Health Organization or should we listen to Donald Trump. They removed themselves from all of that and focused on the data. This video itself is looking at management forecasts and analyst forecasts. And this is just one of the figures from the presentation, and I liked it. It says for each colored line, it's looking at the operating earnings growth forecasts for US-based companies. So for the S&P 500, the top 500 companies in America. So this brown line here is in 2011. And it says when analysts first started estimating companies' growth, on average, they were predicting about, say, 22% growth for these operating earnings numbers. Then as time went on and as we got towards the end of 2011, they started becoming more and more conservative and getting down to more realistic numbers. And then they finished off being about 15% growth. So that's a bit of an outlier. Then all these other years, they always just start forecasting between 10% and 15% growth for the companies. Okay? Every year they're forecasting the companies are going to grow at about 10% this year. But then as the year unfolds, they always get more and more pessimistic until they actually land pretty close to the real number when the real number is just about to be released. Analysts at the start of the year when they're predicting, way too optimistic. They keep saying that companies' growth is going to be about 10%, but then we always see it actually comes back down, sometimes very close to 0% for some years. The green line here, 2018, this is an outlier because in the US, Donald Trump got elected and he had massive tax cuts. So the reason the earnings growth was actually higher was purely due to just taxation changes, lowering the tax rate there. So this is a good video to look at. It's about half an hour long. They talk about why managers make these forecasts, why analysts make these forecasts, how they're generally wrong, and how stock markets react to these incorrect forecasts. My final point for thinking about forecasting is to always try and think about things from different perspectives. We could call it a bull or bear case, like in this analyst report. This analyst report for Dr. Pepper, it has a little section here, the bulls say and the bears say. So this is finance terminology. A bull is someone who believes the stock market or the valuation is going to increase. And a bear is someone who believes the prices are going to decrease. So the history of this, people aren't 100% sure, but when a bull attacks, it increases its head, so it throws its head up, so it's an upwards motion. When a bear attacks, it's a downward swiping motion. So bulls are for up markets and bears are for down markets. This analyst has thought about the people who are making arguments that this business is going to be really successful. Best-in-class inventory and operating profitability, lower reinvestment needs than its competitors, higher free cash flow than competitors. But then on the other side, let's think about the perspective of people who don't think this is going to be a successful business. The bears say the overall market's declining. They're going to have less ability to leverage brands to increase price. There's limited pricing power and growth potential compared to other beverages. They're thinking about both sides. They're not getting stuck in their own thought bubble. They're thinking about things that they may not have considered. This is really important for forecasting companies. As you read the annual report, the managers of the company are always really optimistic. They tell you everything good that they're doing. They give you a really good argument for the bull case. They often neglect to tell you all the really good things their competitors are doing. Their competitors may be doing even better things and growing market share faster. They forget to tell you the mistakes they've made or the problems the business is facing. So to be able to get both perspectives, you need to read more broadly than just what managers are saying. You may try and find if there's anyone shorting the stock, that is, betting that the share price is going to go down. See if they have any public research there. Read newspaper articles that are critical of the company and balance your perspectives there. Thinking about the bull versus bear case is really important in today's environment because as we see, especially with politics, especially with using things like Facebook and Twitter that have algorithms that show you what you want, people get stuck in their own thought bubbles. If I think Donald Trump's going to win the election, then I only read information about Donald Trump being good. If I think Hillary Clinton's going to win the election, I only read things saying Hillary Clinton's going to be really good. And we don't think about the good sides of the other candidates. It's the same with business. I started in week 1 by talking about Tesla because they're one of my favorite valuation examples at the moment. Tesla are the company that have the most investors short selling their shares. So this was from January 2020, and over $14 billion US dollars is short sold on Tesla. That means over $14 billion has been invested expecting the share price will decrease. A couple of years ago, I was probably on that side thinking that Tesla are overvalued and there's a really big risk that they're going to go bankrupt. Elon Musk subsequently said that Tesla were very close to going bankrupt at one point. A lot of people still believe that case. They have not updated their opinions. There's many people who think Tesla are either a fraudulent company or they've got too much debt and they're going to go bankrupt. That's why they're betting that the share price will decrease. But on the other side, there's lots and lots of people who think Tesla are a fantastic, innovative company, who are creating best-in-class products, who are going to be the first company to unlock self-driving cars. They're the market leader in electric vehicles, which is going to become the biggest market in transport. So there's different sides. And if you go on Twitter, where a lot of people talking about the cases, the people who don't like Tesla all communicate with each other. The people who think Tesla is the best all communicate with each other. And when they have cross-communication, it's just criticism of each other. They're not actually trying to expand their opinions. If you do a valuation of Tesla, and there is a professor at New York University who's done a really good valuation of Tesla, if you actually think about the data, the trends in the market and their growth in sales and profitability and all those kind of things, like in our comprehensive forecast, you see the valuation is somewhere between the two extremes, and it makes a lot of sense. The two camps don't talk to each other. The short sellers are really adamant that they're right. The people who are long and love the brand are adamant they're right. When you're doing your forecasting, think of it like a debate. Imagine you were given the case that this is the best company, do your forecasting. Imagine you've been given the case that this is the worst company, then do your forecasting and think about which evidence is stronger there. A few more final things to think about when we're doing our forecasting. If we go back to Philip Tetlock and his book on SuperForecasting, there's 10 commandments for aspiring superforecasters. This is a really quick article that you can have a look through to see 10 of the rules that he's come up with to help you improve your forecasting overall. Some of them don't apply to our individual assignments, such as making sure you've got a good team. We're doing this on our own, so we can't have a good team from diverse backgrounds. But if you're in the workplace and doing this, or you're trying to invest to make some money, think about some of these commandments to improve your forecasting accuracy. So now we've talked about how difficult forecasting is, let's think about hedging our bets. We're going to do forecasts. We know our forecasts are probably going to be wrong, but let's hope the error of our forecasting is minimal. Next, we want to do some sensitivity analysis. Sensitivity analysis is really simple. We're going to think about if we're wrong and we were too conservative, what would be the other likely case? If we were wrong and we were too optimistic, what would be a more pessimistic case? So when we do our forecasting, we start with our most likely scenario. Based on what we know of our industry, economy, business strategy, historical trends, what do we think's next for the company? Then we think about what could really go well for the company? What would be an optimistic scenario to forecast? And finally, what would be a pessimistic scenario? When we're doing that, we need to think about the different items that we're forecasting and which ones are the most difficult to forecast. For example, forecasting the interest rates. Interest rates are much more sticky over the couple of years that we're forecasting. We generally don't see massive changes in interest rates over a couple of year period. So that's going to be a little bit easier than forecasting something like sales growth. So when we're doing these base case, optimistic and pessimistic scenarios, think about which of the forecast assumptions we're making are most volatile and we're most likely to be wrong with. We're most likely to make mistakes with things like sales growth. We know asset turnover is usually reasonably steady within an industry and within a company. We know profit margin is most sensitive to the competition with the industry. So if we've got high or low competition, we might get this number changing up or down based on the industry competition. Then we're going to think about historical patterns, changes in industry conditions, and changes in competitive strategy for our firm. So all the stuff from our first assignment. All these different forecasts that we come up with are going to feed into our valuation models and give us a range of likely valuations that we can look at. It's really important that we realize that our forecasting is limited. We're going to have some errors in there. So let's think about a range of forecasts that make sense. When you're writing up your assignment and you've done your sensitivity analysis, don't just do a mechanical change in the numbers. Don't just say I've forecast sales growth rate at 10% this year. So for optimistic, I changed it to 11%. And for pessimistic, I changed it to 9%. That doesn't really tell us a good story about the business. What we want you to do for your sensitivity analysis is tell a business story that would lead to these numbers being realized. What are the competitors doing? What is your business doing? What's happening broadly in the economy that would lead to these optimistic or pessimistic scenarios? If you are able to tell a good story that leads to the optimistic or pessimistic scenario, that's going to lead to more sensible sensitivity analysis and more useful valuation outcomes in that case. In terms of actually doing your sensitivity testing, you can create a table like this for the different assumptions you're making, discuss your optimistic case and pessimistic case. Then when we do our valuation models, how it flows through into the actual valuation models. Just changing one of these items at a time is one way of doing it. Or you could change a few of them to pessimistic once and get a change in share price as well. For example, for Anna's company from last week, if instead of going from 20% down to, I think it was 15% we used last week, if we change it down to 5% sales growth, what does that do to our forecast share price performance? If our profit margin is increasing over time, so we're being optimistic with our profit margin, we're going on a cost-cutting expedition, and we're going to make our business more efficient and productive, we're going to get a higher profit margin. If they're successful in doing that, how does that affect the valuation? Okay, so the sensitivity testing, the mechanics of it are pretty simple. You change some numbers in your spreadsheet, but you need to have a good story behind why those numbers may actually exist. What would actually happen in the real world to lead to those numbers? Moving on to a discussion on forecasting methods. What we talked about last week with our forecasting is, for this particular task, we want you to focus your forecasting on your knowledge of the business. You've done a research assignment into the factors that influence the business performance. We want you to use your knowledge on those factors to think about how the profit margin, sales growth, turnover, all those ratios change in the future. However, there are other factors that you can consider when you're doing your forecasting. Sometimes historical averages are really good. Sometimes they're not very useful at all. Based on how the business is changing, you'll get an idea if the average is a useful number to use. For example, here's Apple's annual sales. We've plotted it from 2010 up to 2016. If you take an average of their sales, this is the average line along here, your forecasting for 2013 up to 2016 would be highly inaccurate. The average is too low. And that makes sense because we know Apple are growing their business. They're entering into new markets. They're releasing new products. They're opening new stores around the world. They're increasing the prices for their products. All of those things that we know about the business would lead us to think that average sales are not a very accurate way of forecasting future sales. We know there's a bit more of a trend in this situation. So if we plot the growth or the sales again, and we do maybe a regression or a trend line, this is getting a little bit more accurate to the actual sales each year. This trend line takes into account that we expect to have growth because we know in the business, new stores, new markets, new products, we have a realistic expectation for growth in sales overall. So sometimes averages may make sense if we know things in the business are expected to be steady. Sometimes trends make more sense if we expect consistent changes based on our knowledge of the business. And sometimes historical data doesn't reflect future performance. Unfortunately for you guys, when you're doing your forecasting this year, you're going to be experiencing this dot point a lot of the time. Historical data will not be able to predict what's going on with the corona crisis this year. Your forecasting will not be able to just use historical average or past trends. You'll need to really consider moving forward, how are things changing. In historically normal times, averages and trends are a good starting point. then you supplement it with knowledge of the firm. This time, you guys are going to have to use your knowledge of the firm and economic analysis and realize the historical data probably is not going to help you with your forecasting, especially for the next year or two. Then maybe if things start turning around in 2, 3, 4 years' time, the historical averages may start to be useful again. Quantitative methods can be useful, but they'll also miss when there's big changes occurring. This year there's a big change occurring, so we can't rely on our quantitative methods. We need to have a good qualitative understanding of what's going on in the business. Outside of the focus for this particular subject, but especially if you're doing economics or finance, you'll have a much better understanding of some of the statistical methods that are getting used. And statistical methods, we might hear big data or AI or prediction models. They're becoming very common in a range of spaces. So they also get used a lot for forecasting firms' performance. We can use things like linear regression, whether simple linear regression or multiple linear regression, to try and predict future changes in accounts such as sales growth based on all the different factors we know about the economy and the business and industry, to try and create prediction models. Now, this is starting to get pretty complicated. We've got hedge funds who are using incredibly sophisticated techniques to try and do this forecasting. We have people who are getting satellite data and tracking how many ships are going around the world so they can get better GDP figures. They realize that shipping is a really important way of measuring if countries are importing or exporting and if the economy is still going. So by getting satellite images of the world and seeing how many ships are in ports and how quickly ships are moving, they realize they can slightly improve their accuracy for country level GDP growth and things like that. We've got people flying drones over companies' manufacturing facilities to see how many cars they've got in a parking lot, to see what they've got in their warehouses if possible. All of these things are then used to build into these really sophisticated quantitative methods to use artificial intelligence, neural networks, all those kind of methodologies to try and predict things. It's a growing space. It can be really useful and often more accurate than people because people have a lot of biases. However, it's not the focus in FSA, so we don't need to worry too much about those methods in this course, but be aware they're out there. And sometimes they have some real great advantages in removing human bias. Sometimes they have real big problems in that they're unable to deal with unexpected circumstances that the models have not seen before. Some other things that you would want to think about, which sort of really relate more to the accounting issues. We've asked you to use annual report data for your valuation. Some companies will have already reported their half-yearly reports for this year. In Australia, the most popular reporting period is the end of June. So most annual reports are prepared up until the end of June. However, there is a lot of variation. So for those companies that are preparing their reports to the end of June, they would have released a half-yearly financial statement at the end of December. Have a look at that and get some more information that's more up-to-date than the 2019 annual report. You may even see that your business has a lot of seasonality in its sales. So if in America they do quarterly reporting, in Australia half-yearly reporting, by being able to look at some of the half-yearly data, especially before coronavirus issues hit, you can then get better forecasting for the full year. Because we've already got half the year's data released, then you only have to forecast for this 6 months for this year's data. So it gives you a little bit more information, and you might see some trends that you have to take into account from seasonality as well. Earlier we discussed that financial analysts prepare estimates of company performance, and I said we can't always trust them. So financial analysts are important. They do play a prominent role in analyzing business information, and they do disseminate this information to the investing community. So they actually do play a very important role, and they do create new information, disclose information to investors, and help try and keep company valuations more accurate and efficient. Analysts get broken down into sort of 3 different categories. We've got sell-side analysts. Sell-side analysts generally work for the investment banks or brokerage houses, and they issue stock recommendations on whichever companies they actually follow. The analysts are normally given an industry to follow or a couple of companies in the same industry to follow, and their job is to know everything about those companies, prepare forecasts and do valuations, and disclose that information to their customers to provide, hopefully, good investment advice. Buy-side analysts work for institutional investors, such as hedge funds or superannuation funds, And their job is to do the same sort of research, but then their company, their managed fund or their hedge fund is actually using that information to make investments with their own money. The sell-side analysts produce a report who gets disseminated to other people, but they're not actually using their own bank's money to invest in those whatever valuations they've come up with. The buy side, on the other side, they've got their own money on the line. And then independent researchers, they often sell their research reports to people based on their knowledge of particular companies or industries. So we've got three sides of analysis. Sell-side analysts are the ones that actually produce reports that we in the public get to see. The buy-side analysts, because their firms are actually making their investment decisions based on the research, we don't get to see those ones. So sell-side analysts do provide estimations of the firm's expected future earnings, profits, and do valuation models and make buy, sell, or hold recommendations. The great thing about sell-side analysts, they often get a lot of ability to speak to the managers, customers, suppliers, competitors of the firms they're following. So they get a lot of really good data about the companies they're following. It is their job to know the company. So they're not just sitting on Google and looking on Google, but they're out there talking to people who are actually working and competing in the industry to get information. So they do discover a lot of good information from doing this. However, the problem with their reports, and the reason why before I said sometimes we have to be a little bit cynical of them, is sell-side analysts often have conflicts of interest. And we know that people respond to their own self-interest. Sell-side analysts often work for investment banks, and investment banks make most of their money by having clients who they will then sell shares for when they go for an initial public offering or consult for when there's mergers and acquisitions happening. So what the analysts for the investment banks want to do is they want to say good things about companies, so the companies like that particular investment bank, and they're more likely to go to them for future business. So they've got this conflict of interest. They don't often want to say bad things about public companies because they might want that public company to be a customer of the investment bank. So investment banks have sell-side analysts. Those sell-side analysts often have incentives to say nice things or be overly optimistic about the companies they follow. And there's a lot of research that shows that sell-side analysts are too optimistic. Very similar to that figure I showed you before, where at the start of the year, they're always assuming 10% growth for the companies, and it takes a while for them to dial that back down to a conservative number. They don't want to be too negative early on. If you look at Yahoo Finance, for example, for many big companies, they've got a little bit of information about the analysts who follow the company. For example, Qantas had 9 analysts following them in 2018. The earnings per share estimates and also revenue estimates that are done for Qantas. It's going to vary for each company. The company I've been using, Gale Pacific, 0 analysts following them because they're a smaller company. There are databases that are created such as IBIS, the Institutional Brokers Estimate System, which is designed to keep track of all the analyst forecasts. So a company like Apple has lots and lots of analysts following them, and we can get all the different times when the analysts have updated their forecast information, their earnings per share, their valuations, if they think it's a buy, sell, or hold. Lots of information on prior analyst forecasts. When the analysts produce their forecasts, they create reports kind of like this as an example. Your assignment, your third assignment, the valuation assignment, essentially is an analyst report. You're pretending that you're an equity analyst and you're producing a valuation report. In the slides, if you zoom in on this, you'll see that they've given this company a 2-star rating. For the valuation, they think it's overvalued. They think the current share price of $66 is higher than their fair value estimate of $52. So they think that investors should not buy these shares because they're selling for a price that is higher than their actual real value. Okay, that's kind of the aim of what we're coming up with in this subject, how to write these. I've been a little bit harsh on the sell-side analyst reports not always being accurate and being a little bit too optimistic because of their incentive problems. There are lots of media articles, there's some comments in your textbook, and there's a lot of research looking at this information. So a few of the things here, after the dot-com boom in the early 2000s, a lot of the analysts sort of copped criticism for telling investors they should be buying these companies that have no profits, very little in the earnings, and making massive net losses every year, which were clearly overvalued, while other sides, the actual trading side of their businesses, were selling these companies. So there was this conflict there. Goldman Sachs got into a little bit of trouble because their analysts were sharing different information with their in-house traders and their long-term research that they were producing. So again, what they were telling the public and what they were doing themselves, a little bit of difference there. Because analyst forecasts do get released and there's databases following these, there's a lot of research into how accurate they are. Early evidence, such as back in 1978, suggested that analysts are superior over simple time series models like the regression or trend following we looked at before. However, more recently, such as in 2012, this paper finds that simple random walk earnings per share forecasts are more accurate than analyst forecasts over longer horizons for smaller or younger firms, and when analysts forecast negative or large changes in earnings per share. A simple model, like a trend analysis, or just assuming last year with a bit of random movement, is more accurate than the analysts. So that can be in these certain situations. So that can be a bit of a worry there. But then as more research is conducted, we find that analysts can be better in certain situations. Philip Tetlock talked about how crowdsourcing data is really good. So these authors looked at a business called Estimize, which uses crowdsourced earnings forecasts. And they found that the crowdsourced earnings forecasts were much more accurate. So they can be really beneficial. That's part of getting a good team, right? If you've got a big team all coming up with estimates, eventually the team will get things more correct often than the individual. So although individual analyst forecasts may not be great, as we start to combine lots of analyst forecasts, we can improve our accuracy there. And as the incentives of the analysts change, we can also improve our forecast accuracy. So in this paper, they find analyst recommendations relative to consensus are positively associated with investment banking relationships and brokerage pressure. In plain English, when sell-side analysts are working for an investment bank, they have pressure to be overly optimistic. There is a positive association with having this investment banking relationship and their recommendations. They're more likely to say, buy this stock and say good things about it. However, when the analysts have institutional investors who are actually using their information and they've got a different set of incentives, there's a negative association between the presence of institutional investor owners and their recommendations. Depending on what conflicts they have or depending on what incentives the analysts have, they come up with different forecasts. So as we get our analysts and our own incentives aligned, we're going to see more accurate forecasts. And there's been regulation over the last 15 or 20 years that's trying to improve the analyst's incentive structure there. The last thing I wanted to talk about is management forecasts. Please check if your company's managers are releasing any forecasts. It will be a great starting point for you to think about for your own forecasting. If the managers of your business have released any earnings forecasts or forecast how many new stores they're opening or any sort of information about the future, please use that information as a good starting point. However, management forecasts also have certain incentives. Sometimes people accuse management forecasts of pumping up the share price in the short term. They release good forecasts early on, then over time they might unwind some of those overly optimistic forecasts. Research has shown mixed results. The management forecasts are not systematically higher than existing analyst forecasts. So because managers do get tracked on if they're saying things correct or not over time, they're not going to lie to the public. They're not going to be saying things that are clearly wrong over time. But they might be overly optimistic about their own firm's performance in the future. Please look if your company has management forecasts. For example, Woolworths, they're telling us how many new stores they're opening, how many Dan Murphys they're planning to open. They're going to give you some forecast of the future. Qantas are telling us how much they expect to spend on fuel for the year, which is one of the key inputs into the forecast. Their depreciation and amortization expense, they can forecast that pretty well, so they provide it to you in advance. Check out if you've got these kind of forecasts. Good starting point. Don't trust it 100%. Apply your own analysis to those numbers and maybe use it for an optimistic situation and then change your numbers for some of those other base cases. So overall, this week's lecture was much more theoretical than last week's lecture. Last week's forecasting lecture focused on being able to actually use the forecasting template. This week's lecture discussed some of the theoretical issues around forecasting, some of the problems with forecasting about how we're generally going to make mistakes, but there's some strategies that we can implement to try and minimize the errors we make. We learnt about the importance of sensitivity analysis, how there are other quantitative models available to forecast into the future, and there are situations in which they're fantastic and situations in which they're not very accurate for us. So knowing when to use them and when they might fail is important to know. We learnt about analyst and management forecasts and how they may have incentives to not always be 100% accurate with they do provide useful information for us, but sometimes a little bit too optimistic. Next week, we're going to use our forecast and we're going to apply it to some valuation models. We're going to look at price multiples and the dividend discount model as simple ways of valuing a business before we then move on in the following week to the remaining valuation models. Thank you very much and see you next week.